That is what backs every single physical ounce available for delivery at COMEX right now. The March 2026 futures contract carries 528 million ounces of exposure against 113 million ounces of registered silver in the vault. 4-to-1. And the entity controlling 40% of that paper market is the same entity extracting physical metal at 785,000 ounces per day. That entity is JP Morgan. What it is doing right now is either the most disciplined institutional accumulation in commodity market history or the most sophisticated exit setup ever constructed. I'm Marcus Caldwell, independent market analyst. I've been tracking this delivery cycle document by document. Today you get all three scenarios, the full map, including the paths silver bulls don't want to see. Before I reveal the next critical data point, if this intelligence is valuable to you, hit that subscribe button and turn on notifications. The Equity Edge exists to give you the market intelligence that institutional desks track, but retail investors rarely see. Independent analysis, no products, no signals, just the data. Now let's get into what the smart money is actually doing. The fingerprint in the primary source. Data. First week of January 2026. COMEX warehouses recorded a 33.45 million ounce withdrawal in 7 days. 26% of registered inventory gone in 1 week. On January 7th, JP Morgan issued 99% of 8.1 million ounces in delivery notices. Here is the detail that changes everything. Open interest increased by 1,431 contracts during that same delivery period. Open interest rising while physical delivery is being taken is not the signature of a speculative long being squeezed out. It is the signature of a strategic accumulator running two operations simultaneously. Left hand extracts physical metal from the vault. Right hand adds new futures contracts to preserve upside exposure. Both hands serving one objective: maximum physical acquisition at current prices with full paper exposure to every dollar of subsequent appreciation. COMEX delivered 86.4% of its registered inventory in 60 days, the highest 2-month delivery rate in exchange history, while managed money positioning collapsed 77.72% year over year. Speculative traders abandoned silver. Physical delivery accelerated. That inversion is the structural fingerprint of an institution that does not need retail momentum. It needs available metal. It has been taking that metal every session while the crowd looked away. 3 mechanisms tightening the grip right now. 3 developments converged in the past 2 weeks. Each one tightens the same market. First, the Sprott Physical Silver Trust doubled its capital raise from $1 billion to $2 billion on January 20th. At current prices, $2 billion acquires approximately 18 million ounces of physical silver. 16% of the entire COMEX registered vault from a single trust's equity program. Sprott and JP Morgan are now the 2 largest physical accumulation programs in silver history, competing for the same depleted inventory simultaneously. Every ounce Sprott pulls from the vault validates the price at which JP Morgan's estimated 750 million ounce position is marked. The competition itself is a tightening mechanism. Second, Stanford University published findings in Nature Materials on January 16th, confirming a 3 nanometer silver coating solves the cracking problem, blocking solid-state battery scaling. Industry modeling estimates approximately 1 kilogram of silver per 100 kilowatt-hour battery pack for Samsung's solid-state architecture. If solid-state batteries reach 20% electric vehicle penetration by 2030, that single application adds 514 million ounces of new annual silver demand, against a global mine supply of 835 million ounces. That is not a marginal addition. That is a demand doubling from one catalyst. JP Morgan's research desk published the $81 silver average for 2026. It read that Stanford paper. It understood exactly what 514 million ounces means for a market already in its 6th consecutive deficit year. Third, the silver JP Morgan lease to Industrial and Commercial Bank of China at 8 to 12% lease rates since October 2025 is contractually due for return. Shanghai Futures Exchange inventory sits at its lowest level since 2016. China's 44-company export whitelist is blocking new refined silver from entering the system. Whether ICBC can source replacement silver in this market determines whether J.P. Morgan's lease income converts into additional accumulation or triggers a delivery stress event inside the Chinese banking system. That variable is not priced into any current silver analysis. 3 scenarios, 1 institution. 3 different destinations. The financial intelligence that matters is not the scenario that confirms your existing thesis. It is the one that shows you where you are wrong before the market shows you. Scenario 1 is the strategic bull execution. J.P. Morgan holds its physical position as multi-year strategic inventory and monetizes through 3 simultaneous income streams. Lease income at 8 to 12% on silver lent to industrial users. Futures appreciation as paper price moves toward its own published $81 average and toward the Bank of America target of $135 to $139. ETF management fees on the 517 million ounce SLV custodial position regardless of price direction. The feedback loop is structurally self-reinforcing. Physical accumulation tightens supply, price rises, ETF inflows increase, more vault depletion, wider physical premium, cycle amplifies until price discovery reaches structural reality. Scenario 2 is the sophisticated exit. J.P. Morgan uses its 40% futures control to drive paper price to the level that maximizes liquidation value of its physical position. Research notes become increasingly bullish. Retail inflows provide the institutional buying demand that J.P. Morgan sells into. The narrative creates the exit liquidity. This is not theoretical. It is the documented historical behavior from J.P. Morgan's own 8-year silver manipulation period that produced the $922 million Department of Justice settlement. The playbook exists. It has been executed before. The transition from accumulation to distribution will not be announced. It will appear only in the data. Scenario 3 is the position size uncertainty. The 750 million ounce figure is a data reconstruction, not a primary source confirmed number. CFTC bank participation reports are published in aggregate. Individual positions are never disclosed. The January 7th delivery report showing J.P. Morgan issuing 99% of notices is primary source verified. The total position estimate is derived by cross-referencing multiple sources. It may be accurate, it may be directionally correct, but quantitatively overstated. Any thesis built on an estimated position carries the specific risk that the estimate is wrong in the direction that matters most to your capital. The math that requires no estimation. 528 million ounces of paper exposure against 113 million ounces of registered physical silver. 60% of registered inventory demanded on first notice day alone. 820 million ounce cumulative deficit across 6 consecutive years. SHFE Shanghai inventory at a decade low. Stanford battery application potentially adding 500 million ounces of new annual demand to a market producing 835 million ounces annually. None of this resolves through financial engineering. Margin hikes suppress paper price temporarily. Cash settlement defers delivery temporarily. The physical shortage requires one of 3 exits. New mine supply taking 7 to 10 years to develop. Demand destruction at prices high enough to force industrial substitution. Or permanent structural decoupling between physical Eastern pricing and paper Western pricing. One of those is coming. The data does not tell us which. It tells us the timeline is accelerating. 4 signals this week. Watch the CFTC Bank Participation Report at cftc.gov for shifts in commercial bank silver concentration. Watch SLV daily holdings at SEC Edgar. ETF inflows, adding to J.P. Morgan's custodial position versus outflows, tells you whether accumulation is continuing or transitioning to distribution. Watch March delivery cycle volume at CMEGroup.com. If the 60% first notice day rate continues, the registered vault math becomes unsolvable without exchange intervention. Watch J.P. Morgan's next published silver research note. When accumulation completes and distribution begins, the research desk publishes the bullish thesis that creates the retail demand the institution sells into. That research note is the signal before the signal. Write structure in the comments if you're reading the primary data, not the headlines. All sources are publicly verifiable at cmegroup.com, cftc.gov, sec.gov, nature.com, and sprott.com. The Equity Edge. Independent analysis. No products, no signals, just the data.